these companies are well positioned, and I think that there's an opportunity for anyone trying to get that hedge or that portfolio hedge or get exposure to gold to really look at the individual gold equities as a way to do that.
All right, so hello and welcome to another session of the Assay Live. So joining me here today to talk about what's happening in the gold and precious metals markets, we have Fahad Tariq, Vice President, Equity Research Precious Metals at Credit Suisse Securities Canada. So Fahad, thanks for joining us here today.
Great, thanks for having me.
And so recently, the U.S. Federal Reserve Chair, Jerome Powell, he made a recent speech in Jackson Hole that sent the stock market crashing, as he noted that fighting inflation is the Fed's top priority, therefore kind of ensuring the continued high interest rates and slower growth in the economy. What have you seen? What has been the market sentiment coming out of this speech, and what's the impact that you're seeing on the gold markets?
Yeah, so specifically for gold, I mean, just taking a step back, the more aggressive and hawkish the Fed is, the more they're trying to raise rates, the more negative that is for gold. So of course, higher interest rates means the opportunity cost of holding gold is higher. And so typically when you have higher rates, gold prices go down. And so that's broadly speaking what we've seen. And so at Jackson Hole, going into the conference, I think there was this expectation that perhaps we'd get a more dovish tone from the Fed. Maybe they'd be looking at the economic implications of higher rates and thinking, maybe they don't need to raise rates as quickly. We didn't get any of that. So it was really doubling down on the same messaging. It's going to be very aggressive. Inflation is the number one issue that they are trying to address. And so this idea of what's known as a Fed pivot, pivoting from a hawkish position to a dovish position, it never happened. It never happened at Jackson Hole, and it hasn't happened in subsequent weeks. In fact, just today, we got the most recent US inflation data, which suggests that inflation in the US is 8.3%. And for context, the expectation was 8.1%. So it's higher than consensus expectations. And it's only a little bit lower than what we saw in July, which was 8.5%. And of course, in June, we had the peak of 9.1%. So you're really seeing this persistent high inflation. It's not really coming down very quickly, despite the fact that the Fed is very aggressively raising rates. And so all of that put together means the Fed is sticking to their game plan. They're going to continue to raise rates pretty aggressively. And so all of that means, a pretty challenged environment for gold.
Okay. And I guess that kind of brings us into, the outlook for gold. So, your bull and bear case, what do you see happening moving forward for the market?
Yeah, so I described the bear case a little bit now, which is, Fed continues to raise rates aggressively. Tackling inflation is pretty much their only objective at this point. Even if it results in a recession, even if it results in higher unemployment, they really need to control prices and have price stability 12 to 18 months from now. Mm-hmm. That's the bear case for gold. You're going to see higher interest rates. And if their plan works, you'll also see lower inflation. So the combination of those two things, higher interest rates and lower inflation, means that real rates will trend higher. And when that happens, typically you see lower gold prices. We've seen this historically, and that could be what plays out. So that's the bear case. The bull case for gold is, at some point the Fed does pivot and they say, look, if we continue to raise rates, we're going to cause widespread economic issues. We're going to have very high unemployment. Of course, the debt structure of the United States and even globally is very different now than it was the last time rates were high. There's a lot more national debt, federal debt, there's a lot more household debt. So the ability to absorb higher interest rates is much more challenged now than it was, several decades ago. And so they may come to the realization that, look, we actually can't raise rates past a certain point, even if inflation is high, even if it stays persistently high, we have to stop. And if that happens, then you have kind of paused interest rates. but high inflation. That would actually be positive for gold. The other, and a lot of economists are starting to think that maybe that results in a stagflation type of environment where you have raised rates enough that you're slowing down the economy, but inflation remains kind of stubbornly high. And so you have stagflation, and that could be positive for gold. The other bull case for gold is, total recession, economic slowdown globally and in the United States. Typically, gold tends to perform well in a recession. Why? Because it's considered a safe haven asset, and it's an alternative to holding equities or bonds or something else. And so typically in a recession, following the onset of recession, gold tends to do quite well. So those are the scenarios for the bear and bull case. The bull case, really, you would need to see a pretty sharp economic slowdown. The other thing I would say is, gold prices today are actually pretty elevated. If you think about how strong the US dollar is, how high interest rates are, gold prices are still above $1,700 an ounce, which historically is a pretty elevated price. And so the question comes up, well, why is that? Why is it that it's still elevated despite these macro headwinds? And the answer is because people are afraid of stagflation. They're afraid of a recession. And so these factors that I mentioned for the bull case are already supporting the gold price today.
Interesting. I mean, you bring up this, this long-standing idea that gold has been this safe haven asset. Do you think that that's going to continue to hold true moving forward? I heard a bit of conversation recently about, people comparing, Bitcoin or various other assets and kind of questioning whether gold still held this place. What's your take on that?
Yeah, my take on that would just be pointing to what's happened this year, right? So, there was this argument last year that if you want an inflation hedge in your portfolio, now you have multiple choices. You have gold, you have cryptocurrencies, not just Bitcoin, but multiple cryptocurrencies. And so that was the argument that was made that, part of the reason why gold isn't doing better is because you have this alternative now that lots of people want to invest in. Fast forward to this year, when you actually started seeing the high inflation, the 8%, the 9%, 10% in the UK, for example, what's happened? Gold, I would argue, has actually performed its function as an inflation hedge. It's been one of the best performing asset classes. Yes, it's down 4 to 5% year to date, but relative to every other asset class, it's outperformed. Bitcoin is down, like 60% or 70% year to date. So I would say the data suggests, and the performance of these asset classes year to date suggests that gold actually did a better job hedging against not just inflation, but hedging against, portfolio, the entire portfolio. If you're holding equities or bonds, gold did a good job of hedging against that. The other thing I would say is, I think a lot of investors have come to the realization, and we actually ran the numbers on this, the correlation between gold and equity. So let's say you have a portfolio that you have some gold and you also have stocks.
Yeah.
They're actually fairly uncorrelated. So, gold doesn't necessarily move the same direction as stocks. And that's what you want. That's how you get an effective hedge. Now, if you look at what cryptocurrencies have done or Bitcoin has done, they've actually moved almost identical to like baskets of US equities, particularly technology stocks. It's actually, if you chart like the NASDAQ, for example, year to date and Bitcoin, you'd be surprised. You'd think you're looking at the same thing twice because they move so closely together. So, I mean, look, I think it's early days for cryptocurrencies. I don't want to make any long-term predictions, but I would say right now the data and the performance suggests that gold actually has been doing a pretty good job as an inflation hedge and also as a portfolio hedge.
Okay. And so you started to touch on this a bit, but on the investment front, we are seeing a little bit of a disconnect between gold performance and gold equities performance. Can you explain a bit about what you see happening here?
Yeah, so I mentioned at the outset that, if you just take a step back, I know gold has been up and down this year. It went over $2,000 an ounce. Now it's around $1,700 an ounce. But if you just take a step back, even $1,700 an ounce is quite elevated from a historical perspective. It's a multi-year high. And, given the fact that gold is elevated, historically speaking, it's surprising that gold equities haven't performed better year to date. So in an environment where gold is down 4 to 5% this year, gold equities are down like 30% or 25%. Like, it's been a complete disconnect. And And so that's part of the reason why we see so much value now in gold equity specifically, because we think that they have been oversold and there's just been a complete disconnect between what's happening with the commodity, which is a slight decrease, and what's happened with the equities, which is a very substantial decrease. And it's not lining up. And so the question naturally comes, well, why is that? Why is it that investors are selling off gold equities if the commodity is kind of doing okay and actually doing better than most asset classes? And the answer is a lot of investors are concerned about cost inflation. And so they look at the gold equities and these miners and these producers, and they say, well, look, over the past few quarters, you've had your costs increase substantially. Everything from fuel prices to cyanide to labor costs, all these things are coming up higher and higher each quarter. And companies have had to revise their cost guidance higher as well. So that concern about higher costs, lower margins, it's really resulted in the entire gold equity sector re-rating lower, because investors are just concerned that you're going to see margins getting eroded. My response to that would be, yes, we've seen some margin compression, but not nearly what is being reflected in stock prices today. These companies are still very healthy. Balance sheets are extremely strong. Most of the companies that I cover are in a net cash position. That was unheard of, a decade ago. And their free cash flow yield is still very healthy, assuming spot prices, or even assuming slightly lower than spot prices as we do next year. It's still a very healthy level. And so you see these companies paying very high dividends. Most of the gold producers now are paying, north of 2% dividend yield. That was unheard of a decade ago. So you have all these factors that fundamentally these companies are stronger. The gold commodity is kind of okay, down a little bit, and yet the valuation of these gold equities it's really, really low. In fact, many of the companies I cover are trading at multiples now, valuation multiples now, that are 10-year lows. And so we just think this is a very attractive, part of the cycle where, these valuations look really attractive to enter. And if you want exposure to gold, these equities look really, really inexpensive at this stage.
Interesting. A lot of analysts and investors talk about gold's place within an investment portfolio. Are there any kind of overall ideas about how it's best placed within your portfolio? Maybe this is more for like a generalist investor, but yeah.
Yeah, so the number that I've heard before is 5% of the portfolio should be allocated to gold, and so and there's different ways to do that. So, for example, some generalist investors, and let me take a step back. The 5% is really as a portfolio hedge, right? Mm-hmm. Like I mentioned, gold tends to be uncorrelated with stocks. So if you have an environment where, let's say, you have a downturn in the stock market and equities more broadly, you want something that can at least be uncorrelated to that to offset and have better overall performance of the portfolio. So that's where the 5% comes from. In terms of how to get exposure to the 5%, there's different ways. So you can either buy physical gold, you can buy a physical gold ETF, or you can buy gold equities. And so, I think if you looked across portfolios today, typically speaking, not many funds or portfolios have 5% gold. They're underweight gold. And so we see an opportunity for generalist investors to start allocating more to gold. And in fact, when that generalist capital comes into the space, it has a huge impact on valuation multiples. And we saw this in 2020 and a little bit in 2021. But in 2020, when gold prices really started taking off during the pandemic, when there was a lot more money supply, you really saw generalist investors position more in gold equities, and gold prices really took off. Gold equities started trading at very high multiples. And we haven't seen that in more recent years. So, I think that's kind of the thinking where if the generalist investor can get to the 5% versus right now maybe being at 1%, if that even, that could really make a difference in terms of valuation multiples. And you could see these stocks re-rate quite a bit higher.
Okay, interesting. For my last question, I thought we could change direction a little bit, talking a little bit more on the mining side in ESG. So ESG has been really front and center to all of the industry discussions that we're having over the past few years. How do you see this latest discourse on ESG impacting miners, and how are they finding their way forward?
Yeah, it's interesting. I feel like every year there's like a theme for the miners, and last year for sure I would say the theme was ESG. This year the theme seems to be more about cost inflation because everyone's really concerned about that. But that element of ESG and that focus is still very much there. In fact, most presentations, corporate presentations, when you look at them, the first or second slide is about ESG or sustainability. That wasn't the case, years ago. So the focus is there. I think what's happened now is investors have become more sophisticated. The companies themselves are responding to those sophisticated investors about ESG. And so there's more nuanced and specific discussions about how to decarbonize. So whereas before, I think a lot of miners were just setting targets saying, 30% emissions reduction by 2030 or net zero by 2050. And that was fine. That was all welcomed. I think now the discussion has become much more sophisticated where it's, well, what is the pathway to get there, right? 2050 is like a long time away. So what is the pathway to get there? What are the intermediate steps? What are you doing? And so if you take a step back and you think about, well, where are the most of the emissions coming from? It's really the energy consumption at the mine. How the energy is generated to run the mines. And so there's been a big push for renewable power at mines, for example. That's been a big area of focus. And so that's a very common pathway that a lot of companies talk about, whether it's solar power, wind power, or using more efficient ways to operate their fleet, maybe using battery electric fleet. Those are the types of things these companies are talking about. But yeah, the discussion has become more nuanced and more specific. The other thing I think the gold mining sector, and I've said this before as well, that they could do a much better job of, and they started to do that now, is really communicating the economic and social benefits of these mines.
Yeah.
I think it would surprise many people to know that in a lot of these countries, the best paying jobs are at these mines. And there is tremendous economic benefit from just the jobs, buying supplies locally, the tax revenue for the host country, and on and on. There's a lot of economic benefit. And this is particularly important in this environment where a lot of these countries have, they're trying to balance their budget and there's difficulty during the pandemic, et cetera. So I think that's something the mining sector can highlight for sure and do a better job. And you're starting to see more of that, but definitely on the E side of ESG, the environmental side, there's room for improvement, and you're starting to see a lot more specific commitments on renewable power and decarbonization.
Yeah, absolutely. I know a number of the junior miners that are taking part in our events across the board this year are certainly kind of trying to highlight those as well. So yeah, that's all really quite interesting. That was all the questions that I had for you today. I don't know if you have any kind of thoughts moving forward, or final notes on where you see gold going moving forward.
Yeah, so I mean, as a final takeaway, I would say our forecast is gold prices could trend a little bit lower next year. We're forecasting $1,650 an ounce in 2023. Now, someone may think, well, that means that we're bears on gold or that we're not very constructive. But in reality, we think that the gold miners themselves are actually really well positioned. Again, the stock valuation, the equity valuation, very attractive. The fundamental strength of these companies, very attractive, excellent balance sheets, really, good dividend yields that are growing, good free cash flow generation. These companies are well positioned, and I think that there's an opportunity for anyone trying to get that hedge or that portfolio hedge or get exposure to gold to really look at the individual gold equities as a way to do that. And so that would be my final takeaway.
All right, sounds great. Well, thanks, Fahad, for being with us here today.
Happy to be here. Thank you.